afternoon, folks. Welcome back. This is The Real Men of Real Estate, Sundays at 1 p.m. on KCAA Radio. We're at 106.5 FM, 1050 AM on your dial. And I'm talking with Chi Nguyen about note investing. So we were getting into the due diligence aspects. And so after you find a loan and you check out what its status is, what if there's more senior liens, and start to figure out its value relative to the property, what's next?
Yeah, so like you would check out the enforceability of the note, the occupancy, is it owner occupied or vacant,
Okay.
or is
A
it
rental
investor?
maybe. Hmm.
And that would help determine whether or not, um, you're trying to determine the emotional equity. There are some second
I
position
see.
acquirers out there who actually purchase notes with a perceived no equity, just because they see that there's emotional equity there. If it's a
Mm,
family who has young kids and they're going to school there and they've been there for 20 years, it's likely that they'll try to figure out some sort of loan
hmm.
modification. They'll come to the table and work with you for some sort of loan modification when you
Hmm.
after
So
you've
you
purchased.
you can help them solve a problem.
Yeah, exactly. There's a lot more to it, but then I would basically look into the actual makeup of the house, the neighborhood, the crime, the school ratings. Then I would look into the back taxes. Are there any back taxes? Title. And then I would eliminate from there whether or not I want to actually continue purchasing on the note or not. But looking at credit reports is actually huge in the second position note, because
Okay.
they say that in the second position, you always research the borrower more so than you do in the first position. The first position is primarily interested in taking a look at the
At the
property
property itself. Okay.
historically. But I mean, I actually semi disagree with that, because if you foreclose in the second position, you take the property back too, just
Hmm.
subject
Hmm.
to the first position. You make those payments on the first. Um, yeah. And then I would look at pay history and communication log, from the borrower
Okay.
servicer. And then from there, I would do pricing. I would predict and project my expenses, how much I'm going to spend on legal, whether or not this borrower has been very litigious in the past with previous lenders. And
I
then I would
see.
determine and project exit strategies like foreclosure, or maybe that I think they're going to reperform, or maybe they're going to file bankruptcy likelihood. For example, there's a high likelihood that a borrower will file bankruptcy if they have high equity in the property,
I
but they
see.
can't afford the payments.
Got it. All right. So there's a tremendous amount of detail
Yeah,
that goes into this.
a
All
lot.
right. I'm sure there's a lot of help folks can get when they're getting started on this, but if they're in it already, maybe they're just getting going. How can they protect themselves? What are the kind of common strategies? Small pool, not a high dollar in situation. How can you most effectively protect yourself?
Good question. The way I most effectively protected myself and was to calculate and mitigate my risk in the beginning by only
Mm,
focusing on a small section of the market. So for
okay.
me, I already knew second position liens at the time were way less popular than first position liens. So already, I would have a very, very specialized niche where I might be a bigger fish in a smaller pond. And so
Hmm.
not only would I have a higher likelihood of winning a deal, but pre- I'd also, I guess, put myself in a position where I knew more about the notes, and that strategy more than anybody else. So for me, I chose non-judicial states when I first started, because the foreclosure timelines are a lot shorter than judicial states.
Yes.
And I only chose a few states that I would invest in, like California, Colorado, and a few Texas, a few others that
Hmm.
I would do. I think I did. I was looking into Georgia before I found out you needed to have a license. So
Oh.
just finding out, each state specific set of criteria you'd
Hmm.
have to know, and then also hiring the right attorneys. I think that in the note investing space, the attorneys are really just your right hand man and woman, or men and women.
Hmm.
You have to know that they know what they're doing and that they don't have long, just super elongated timelines in terms of their ability to respond to you, their ability to get notice of demands out, or notice of trustees sales out, uh, or um, affidavits out or anything like that. So a very
Okay.
knowledgeable, experienced, and responsive attorney is probably one of the best ways. And also have them review your collateral files before you close, and then let them tell you whether or not there's anything specific in the collateral file
Hmm.
that might prevent you from a clear path of foreclosure.
Okay. So is the collateral file some of the due diligence you were mentioning a few minutes ago?
Yes. So the
Okay.
collateral file is basically the note and mortgage and then the assignment chains that come with that. So when a note is purchased, let's say Wells Fargo originated that note, then they sold it to Bank of America, like I said,
Uh-huh.
right? They then would do an assignment of mortgage, which means they're giving this mortgage to Bank of America after Bank of America has purchased it. So you want to make sure the assignment of mortgage is correct, the chains of everything, basically just making sure title is clear and that you have full ownership of the note that you're purchasing.
I see. Okay. Wow, that is absolutely fascinating. Um, are there any other steps that you're going to take before deciding to invest in a given note or pool of notes?
Well, I think I just listed off
I,
20
th-
to you.
I,
That's quite
yeah,
a bit. Yeah, I
yeah.
guess
So I mean, I guess more broad scope. You know, you've done your due diligence. You've got a system to protect yourself. Is there any other high level steps that are important to take, or is that point once you've covered the ground there, then you're ready to make a purchase?
I see. Yeah, so I guess we're really speaking about the due diligence period now. So after you've like sent in your indicative bid to the seller, they
Hmm.
accept it and then they send you those collateral files. And
Okay.
then you look through each one, you make sure everything is in line. Um, I guess just making sure that your return is that you're going to be able to hit your return after that, after
Okay.
you've delved a little bit more into the file, that, your initial predictions are matching what you're now seeing so that you can
Okay.
comfortably and accurately predict your yield going forward.
Okay. All right. That's fascinating. So then that's time to actually pull the trigger or move on and do the process again.
Yes, exactly.
Okay.
Or fade the bid. We call it fading the bid. So if you find something out in the due diligence period that the seller did not previously disclose to you, like, hey,
Hmm.
actually there's HOA liens in the amount of $30,000 on this asset, and you're in a super lien HOA super lien state, which
Okay.
means the HOA liens are supersede yours. And then maybe that takes out some of your actual equity that you originally saw when you first looked at the asset. Then you would fade the bid. You'd say, hey, I'm not even fully covered anymore. I'm actually going to fade the bid by this much. Or, hey, I found back property taxes, delinquent property taxes in the amount of $10,000. Have those been paid? If not, we might fade our bid by X amount, especially if you're in the first position. You would definitely want to fade the bid by the exact amount of property taxes that you,
Right. You're going to end up paying that no matter what.
yeah.
Okay. Are there any other common issues that come up? Is there kind of a general pool of issues you come up to after you do your due diligence, or is it just kind of hit and miss?
I guess the common ones are, if you're looking from the first position, like I said, back taxes, like property taxes is really common, HOA liens is really common, IRS liens, if that supersedes yours or not. That would be the first position that comes up a lot in. Second position, I guess what does come up sometimes, not a lot, is that maybe the property is in a lot worse of condition than you
Oh,
thought. So I would recommend in both the first and the second position lien, um, that you send out some sort of property inspector, not a property inspector in the same way as, when you purchase a property, but we have drive-by inspections from property preservation companies. They'll
I
go out
see.
there for a nominal amount of maybe $20 to $25, sometimes 30 to 40. They'll drive out, they'll take photos of the property, as many as they can, and they'll send them to you so you can see what the actual real-time live status of the property is. I mean, I've been in due diligence for assets before where there was no property anymore.
Oh my
They're
gosh.
down, or maybe there's a huge, huge hole in the roof from a fire. There's, it's boarded up and vacant, or there's, a meth house there. Like literally those things come up, and
So you've seen it all.
Yeah, the only thing you can't, the only way you can figure that out is getting somebody out there to put real eyes on the
Hmm.
property,
Yeah, boots on the ground.
boots on the
Okay.
ground.
All right. Do you talk to the owner, the property owner at any point through this process?
Only after you've purchased the loan. It's
Oh,
highly
okay.
frowned upon for you to reach out to the borrower while you don't own their mortgage. I mean, think about it. That'd be
Hmm.
so weird. If somebody called me and they said, "Hey, that mortgage on your house, I'm looking to buy it. Can I ask you some
Right.
questions?"
That
I'd
would
be like,
that would
"No."
freak him out. Yeah.
Yeah. No, you can't do that actually. So, no, you can have your servicer reach out to them after you've purchased the note. So after we purchase the
Okay.
note, we board it at a third party company, a servicer. So for any of you out there who have mortgages, the payments that you make to a company, like let's say there's Mr. Cooper, there's Specialized Loan Servicing, there's Loan Depot, there's sometimes it'll show up as Wells Fargo, but that's Wells Fargo's servicing side of the company. You're not making payments directly to the bank. You're making payments directly to the servicer, who then
Got it.
sends those payments to the lender. And we have the servicer reach out to the borrower because they are licensed to do so. I would highly recommend not reaching out to the borrower personally because you
Okay.
put yourself into some Dodd-Frank issues if they are
I see.
investors,
Okay.
they're not investors. You might be saying the wrong thing. They might tell somebody later down the road that you were intimidating them. You may
Hmm.
tell them the wrong information. You're just not licensed to do it. And so to take that liability off of our plates, we just have the servicer do it and we pay them.
Okay. That's fantastic tip. Wow. Well, it's time again for another commercial break. So, folks, hang on. We'll be right back after these messages. Thanks so much for listening.